Hey, hi there. Welcome to Stock Talks with Aakash. And today we'll be learning all about price to book ratio. So let's go directly to the blackboard. So we'll be learning about price to book ratio. So we'll go by words. Okay. It is nothing but the price. Of course, it is the current market price and by the book. Book is nothing but the book value of the company per share. Okay. A book value is the value that you get once you have sold all your assets and paid all your liabilities. The money that is left is the book value. Okay. Questions now come out to be how do we calculate book value? Okay. Let's see. Book value. It's very simple. You have to sell all the assets. So you have to consider assets. You have to pay all your loans, which is liabilities. This is the book value. And you need it per share. So we need book value per share. You need to divide this value that you get by number of shares. This is book value per share. Sometimes what happens is the owners does not want to dilute its voting rights and at the same time they want to raise capital as well. So if the owners have raised the capital through preferred shares, then to calculate this book value, you need to deduct that preferred equity. Preferred equity. You need to deduct it from them, then you will get a clearer picture. Okay. So this is all about calculation part. Now we will go into the interpretation part. Hmm. So there are three buckets. One, two, and three. One is book value is equal to one. Now book value is greater than one and it is less than one. If your price to book ratio comes out to be one, then it is fairly valid. Right? Now let's say your book value comes out to be greater than one, then it is considered overvalued. If it is comes out to be less than one, then it is considered to be undervalued. Okay, so these two have another interpretation. Okay, so you have to consider why overvalued? Why are you paying? Why are investors interested in paying over and above the book value? Okay, it could be because the company is doing great in business and the investors know its future earning potential. That is why the investors are ready to pay over and above the book value to acquire one share. Okay, this is another interpretation for this. So, similarly, you need to understand why it is undervalued. Okay, one of the potential reason could be a litigation case has been going on or have been filed just recently against the company. If you think that the company would be able to pass from this phase, then it is a very good part. I hope you get it. So, overvalued is why it is overvalued. You need to understand. It could be perceived future earning potential. Okay, you could say future earning potential, or why it is undervalued. It could be because of any financial distress that the company is facing right now. Financial or legal, etc. distress. So, to understand it better, let me share you an analogy. Okay, we'll take an example. Let's say very simple example. Let's say you wanted to go and watch first day first show of a Salman Khan movie. Okay, first day first show. Fair value is that you go uh, into the movie theater, buy a ticket, and watch the. It's the fair value. First scenario. Let's say second scenario. Overvalued. You go into the movie theater as it's the first day first show of a Salman Khan movie. All the tickets are sold out, and you have to buy that ticket in black from somewhere else who have already bought it, and you can offer double the price, triple the price of the book value. So that's overvalued because it you see in the ticket the potential. Okay, you see a value in it. That's why you are ready to pay twice of the tickets. So that is an example of overvalued. Third, undervalued. For the undervalued case, let's assume there's a couple, um, and they didn't expect it that the theater would be house full, and now they think that we will not get some privacy in a house full theater, and they wanted to trade that ticket, even if they get half of the price and move somewhere else. So you can get the same ticket. Very fortunate enough of you, of course. You can get the same ticket on half of the price. So that is undervalued. I hope this analogy helps you to remember what the price to book value is. Now we will go to how to where to use it or where to not use it. Okay, let's again see uh, the things that are used in price to book. It's the assets that are used, right? So in companies where you cannot gauge or assess the correct asset value of the company, in those cases you cannot use price to book value. Okay. Um, let's say what could be the examples of those? IT companies. In these, their assets are their employees, and media companies. And where you should use price to book is where you can value the assets very accurately. And most important example goes to banks and NBFCs. Okay. Of course, utilities companies, manufacturing companies, pardon of my handwriting, Okay. Now let's look at few examples. How do we interpret it? Let's go to an example. Okay. So you could analyze price to book in two different methods. One is that you could analyze it by itself, like historical value. And second, you could compare it with its competitors. So these are the two ways how we could effectively use this price to book. Okay. Now you are very much interested in ICICI and you wanted to see how ICICI Bank is priced. If we could see on the screen, its median price to book is for 1 year is 3.2, and at present it's just on that line. Let me just bring the mouse. It's 3.25. So it's fairly valued as per price book at present. Fairly valued, right? Now let's compare it with its competitors. So ICICI Bank competitor is HDFC Bank. Now let's see what is the ratio of HDFC. HDFC is trading at 2.8 and its ICICI was 3.2. So if we compare it with HDFC, ICICI Bank is overvalued, right? Now it's the same ratio but two interpretations. If we compare it with historical, it is fairly valued. If we compare it with its competitor, it is overvalued, right? Now let me show you where to not use this. IT companies. If you could see, the ICICI was 3.2, whereas it's extortionate. The investors are ready to pay 14 times of its book value to acquire one share of persistent system. So that's why book value does not play a vital role in these companies. So to conclude the video, let me take you to the conclusion slide. Price to book is extensively used by the valued investor to determine the valuation of the stock. And lastly, we interpret it in three categories. Less than one is could be undervalued, or another interpretation, it's a value trap. One is it is fairly valued, and greater than one, of course, it is overvalued, or the investor think that there is a strong future perspective for this company. You should never use it in the companies where you cannot gauge the asset on papers. If you can gauge it, then this is a very good ratio for those companies. So lastly, it could be used to assess companies' valuation based on its historical price to book trends. It could also be used to assess relative valuation between the companies under the same industry. So that's all about price to book ratio. Thank you for watching, guys. I will see you in the next video. Bye.
Disclaimer: the information provided is for educational and informational purposes only and should not be considered financial or investment advice. I am not a SEBI registered investment advisor or research analyst. Investing in stocks involves risk, including the potential loss of principal. Always conduct your own research and consult with a qualified financial advisor before making any investment decision. Past performance is not an indicator of future results, and all investment carry inherent uncertainties. The author and associated parties are not responsible for any financial losses resulting from the decision based on this information. This channel does not promote any form of guaranteed returns or insider tips. Always invest responsibly. Thank you.